Okay, I'm ready. Hello, this is our business strategy game PowerPoint. We are in Industry 1. Team letter is A. Team name is A-up to Par Footwear. Team members' names are Abby Ford-Stille, Kendall Johnson, Casey Milesko, Divya Pillay, and Sarah Rivas. Next slide.
So our strategic vision for the company, Up to Par Footwear, took a balanced strategy approach, focusing on pursued cost-effective strategies cross-regionally, being competitive where demand was high. Through a variety of strategies, our goal was to become cost competitive by offering lower prices than competitors while keeping an above average SQ rating, providing a high quality product for customers at an affordable price. Next slide, please. So this strategic group map for North America wholesale is from year 11. And our initial competitive strategy in North America was to use a best cost approach strategy, providing a high S&Q rating, as mentioned before, with a reasonable price. Our overall goal was to be as balanced as possible. So we had a product line breadth of 249.1, a PSQ rating of 302.4, and market share of 9.5%. So we fell right in the middle of the pack, as can be seen on the chart pictured here. And our strategy was not strictly focused on North America. So this visual is reflected of our strategy as a whole across different regions. And in year 11, the early group leader that emerged was Group I, with an 11.5% market share as a whole in wholesale in North America. Next slide, please. So ending in year 17 for North America wholesale, again, we had a high quantity of models with a product line breadth of 499.9, and our an average to low pricing. Our PSQ rating was 397.6, and our market share was 9.7%. With an overall gain of 0.2% when comparing year 11 to year 17. Throughout the game, our strategy was to remain a best cost provider, and we found successes with a high number of models, as can be seen in this chart. The early market leadership of Group I led to their continued success and their ending market share of 15%. We chose to stick with our initial strategy throughout the game and did so with the goal of manufacturing where demand was high, staying cost competitive, and not depending on one single region for all profits. The adaptations that we made were adding free shipping, production improvement investments, and a renewed focus on celebrity endorsements. Next slide.
Hello, this is Kendall Johnson. So I'm going to be talking about net revenues now. So as you can see on the graph on the right-hand side, we had steady net revenue growth through year 16, and our average revenue growth was 11.8% from years 10 to 17. In keeping with our best cost strategy and our balanced approach, we tried to have a very high SQ rating relative to the pricing that we were offering in every region. And with that strategy, we managed to maintain competitive performance in net revenues through year 16. However, in year 17, because of some models that were slightly off, our prices were a little bit higher than what we should have done because we expected competitors to price higher. And that pushed us away from our original value proposition. And some clients didn't really see the value in that anymore. But next slide, please.
Hi, this is Sarah Rivas, and I'm covering the earnings per share slide. So as you can see in the graph, the trend is moving upward from year 10 to year 17. The the upward moving trend is expected to increase as the years progress. As our EPS rises, the net revenue trend increases as well. So that's great for us. As the earnings per share rises, the production costs slightly inclined, while labor costs slightly increased in each region as well as a result. Our 3-year strategic plan, we almost hit all of our EPS performance targets for year 15, 16, and 17. Our strategy is currently making progress and will continuously make progress for the years to come. For our 3-year strategic plan, we had targets of 4.5 for year 15, for year 16, 5.25, year 17, 5.5. And we pretty much hit almost all of our targets. So our forecast for the future looks really well. Next slide, please.
Thank you. So back to Kendall Johnson, talking about stock price. So stock price was rather sporadic, but overall there is an upward trend, as we can see in the graph on the right-hand side. We had a 14.9% average annual return, so relatively good in terms of today's stock market, and 110.63% return over the past 7 years. We finished around the middle of the pack, maybe slightly higher than the middle. And perhaps that's because of not aggressive enough financing. So we had a somewhat slower stock price growth in the beginning. But we did focus on creating shareholder value and having very minimal share dilution. And we expect that moving forward, the market might price that in and value that a bit more. Next slide, please.
This is Divya Pillay. I'll be talking about the competitor analysis. So Elite Happy Feet, Company E, seemed to be our greatest competitor. They focused on low-cost strategy, which helped to stimulate the demand and gain in higher market share. They reduced prices by taking to one of the largest market shares of the private label segment. They offered their shoes at a lower cost than our company. They focused on more production in the private label segment, and they also focused on lower prices and more production, which made them more effective competitors. Next slide. So our competitive strategy, we decided that to be more effective, we would up production. The leftover would go towards the private label production. We would reduce pricing, especially in the Asia Pacific area, to make more in the market share. In the private section, our company prices were more expensive than Group E, which drove customers to their products, which were the same quality for a lower price. We can also see in the two graphics what our performance targets were, and then on the right, what our actual numbers were. It looks like in year 17, the only target that we hit was stock price, and we also achieved higher credit rating as well. Next slide.
This is Milesko. I had the lesson learned section. The next 3 slides I'll be covering things that we learned throughout this simulation experience. So some of the lessons we learned in general were to, before the game started, we forecasted annual demand per company, and we ensured that there was at least that much production capacity to meet that demand. And we made a schedule throughout the 7 years in the game, and we made sure that we were on par with that demand, so that we could properly scout out how much space and equipment was needed. We had a strategy to manufacture where the demand is, which helped us minimize exchange rate and tariff impacts. We made sure to maximize asset utilization by ensuring available space and production and equipment are not idle. This helped to lower the total production cost. So this strategy made us more cost effective in pursuing competitiveness in all 4 regions. Ensuring there's a low debt to asset ratio, less than 0.4. I think ours was ending around 0.26 or lower in the end of the game. And that's important to keep our recurring interest payments down over the years. We needed to ensure warehouses are distributed and stocked proportionally relative to the region's expected demand. which looks like a slightly positive surplus per region. And we also found that it was important to pay workers a competitive wage, total annual compensation, so that they will indeed stay productive. And we had a strategy to also slowly replace refurbished equipment in the AP region with new equipment to maintain a higher percentage of new to refurbished equipment. And that helped us reduce reject rates. Some of the things that we learned experientially, at kind of reflecting in hindsight on everything, some of the things that that you should do to be financially competitive, as shown in the numbers that we've seen. In year 15 and 16, we saw some really good gains with celebrity appeal, going from 0 to 220, keeping in mind that it caps at 300, and this is on average per 4 regions. We procured celebrity appeal by offering all of the celebrities an amount that is proportional to their total influence, and this allowed us to capture a 10.7% market share and 175,000 plus in total revenue between years 15 and 16, keeping in mind that the total market share per company, the average market share per company is 9.1, so we did much better than average after securing those 3 contracts. Evaluate return on investment and payback period of production improvement options before investing. When we started, we found that there were a lot of intriguing options that we could choose, but after crunching the numbers, there were absolute options that were more beneficial, and pursuing those options at the start of the simulation proved to be a good strategy. Such that in year 14, 2 improvements came online for both NA and AP regions, which led to about a half dollar earnings per share increase. Also, we found that offering free shipping can offset marketing needs. Year 11, NA free shipping with much lower than average marketing led to a slight increase in North America market share. Also, in hindsight, things that we should not do to be financially competitive. And this list is a little bit longer because there are definitely things that we would have done differently if we were to do this game again. Some of those include, before setting company inputs, forget to focus on accurately predicting rival behavior, prices, SKU, marketing, etc., such that in year 11, we had a minus 21% EPS variance between projected and actual. We were expecting to do very well based on what we were assuming was going to happen, and what actually happened turned out to be quite the different story. In the same vein, over-reliance on financial projections, year 11 through 12, we misprojected the excess cash needed, which unfortunately led to an overdraft loan, and it took our credit rating from an A- to a B, which was not helpful. Paying back that overdraft loan or the large interest rate that was tied to it. In year 12, we invested significantly lower in internet search engine advertising than rival average. For whatever the reason, that was that's what we chose to do, and it resulted in a negative 0.6% total market share, a loss. Year over year. Taking out more debt when you have a bad credit rating. So in year 12, we actually took out $40,000 in debt when we had a B rating, which led to a higher interest expense. Maybe it would have been better to secure additional capital through other means of issuing stock or other methods. Offer higher than average prices when making private label offers. So Kendall mentioned this in year 17, we misforecasted prices, which led to a missing or not having offers for our private labels in 2 of the 4 regions, and that we actually had a decline in revenue as partially as a result of that. So kind of erring on the side of conservatism in the future would have potentially given us a private label offer when we absolutely needed those based on how we were set to produce in the strategy for that year. Taking out debt and repurchasing stock in the same year turned out to be not always the best idea. In year 13 and 14, we could have had a much lower interest expense had we not taken out as much debt. And these are some of the experiential lessons learned. That is it for our presentation. Thank you very much.